Right now, shares of Lithium Americas, ticker LAC, are trading live at $4.815. The stock is currently up 21 cents, a gain of over 4.5% on the session. Volume is already heavy, tracking at 4.46 million shares, as the market digests a significant new piece of analysis that just hit the wires. Now, for many watching this stock, today's green candle might feel like a relief. But the expectation is that this is just another volatile day in a long, painful bleed. The common belief is that LAC is a broken story, a victim of the lithium price collapse. But the reality is that the narrative is shifting under our feet this very morning. The jump we're seeing isn't random. It's a direct reaction to JPMorgan upgrading the stock from underweight to neutral. This is a profound change in sentiment from a major institution, and it forces us to ask a critical question. Was the brutal sell-off that brought us here actually the end of the story, or was it just the violent correction needed to set up the next chapter? The common ground investors have shared on LAC for the past month has been one of deep concern. The stock has been in an absolute free fall, shedding nearly 40% of its value in just the last 30 days. Just 2 days ago, it was trading down over 9%, hitting a low of $4.58. This wasn't just a pullback, it was a capitulation. The expectation, fueled by this price action, was that the stock was heading back to its 52-week lows, possibly lower. The narrative was simple. Lithium prices are in the gutter due to a massive global oversupply, and a company like Lithium Americas, which is still years away from generating a single dollar of revenue, cannot justify its valuation. But the reality is far more complex. JPMorgan's note today cuts to the heart of this. They didn't upgrade the stock because the Thacker Pass project suddenly got better overnight. They upgraded it because after an 18% decline in just 1 week, the stock's price finally reflects the immense risk. The upgrade isn't a buy signal, it's a stop panicking signal. JPM is essentially saying the valuation now more accurately reflects the significant execution risk that lies between today and the project's commissioning, which isn't expected until 2028. This is the classic tension for a story stock like LAC. The market is forward-looking, but it's also incredibly impatient. The recent history of this stock is a perfect case study. We saw a colossal rally, more than 200% at one point, triggered by the news that the U.S. government was not only granting a $2.26 billion conditional loan from the Department of Energy, but also taking a direct 5% equity stake in the company and its flagship Thacker Pass mine. This was the moment retail excitement peaked. People using their Robinhood app or SoFi Invest account saw a U.S.-backed lithium champion in the making. They saw the next Tesla stock, not in building the cars, but in supplying the one resource they cannot be built without. The expectation was a straight line up. But the institutions, the managers at places like Fidelity, or those running Schwab Intelligent Portfolios, saw something different. They saw a stock trading on pure hype, completely detached from the 2025-2026 fundamentals of the lithium market. And so, the stock collapsed. What we're seeing today is the battle between those two timelines, the immediate, painful reality of a commodity glut versus the long-term strategic importance of what LAC is building. Let's look at the recent trading activity because it tells a story of its own. The volatility has been staggering. The stock's average true range is sitting at over 16%, which signifies wild, high-risk daily swings. In the last month alone, the stock has traded in a massive range, from a high of $10.52 to that low of $4.58. We are currently trading near the very bottom of that range. This is not a chart for the faint of heart. Technically, the short-term trend is clearly and aggressively negative. The price is well below its 20-day and 50-day moving averages. However, the long-term trend, looking at the 200-day moving average, is still positive, reflecting that massive year-to-date gain of over 75% that remains even after the recent crash. This technical picture screams indecision. The short-term traders, perhaps using platforms like interactive brokers for their advanced charting, see a broken stock. The long-term holders, maybe using a Fidelity brokerage account for their individual brokerage holdings, see a generational asset on sale. Adding another layer of complexity is the insider activity. On October 1st, as the stock was still trading high, VP Alexei Ilya Zavotsky sold over 350,000 shares at an average price of $9.48. That's a $3.3 million sale. While insider sales can be pre-scheduled, the timing, right before this major valuation correction, is not a confidence-inspiring look. Now, with all this recent chaos, it's easy to forget what this company actually is. Lithium Americas is not a producer. It's a development stage company. Its entire value is tied to one single asset, the Thacker Pass project in northern Nevada. But asset is an understatement. Thacker Pass is the largest known confirmed lithium resource in North America. It is a shallow, open-pit mine that is fully permitted, has survived all legal challenges, and officially began construction in March 2023. This is not a theoretical hole in the ground. It's a fully fledged construction site backed by the U.S. government. The plan is massive. Phase 1, which is what the DOE loan is funding, is being built to produce 40,000 tons of battery-grade lithium carbonate per year. The full project, over 5 phases, is designed for 160,000 tons annually. To put that in perspective, the production from Phase 1 alone could support the batteries for up to 800,000 electric vehicles every single year, and the company has an 85-year mine life. This is, by every definition, a flagship asset, as JPMorgan called it. The importance of this project is underscored by its partners. General Motors isn't just a customer, it's a co-investor. GM has a 38% interest in the project and, more importantly, a 20-year offtake agreement to buy 100% of all lithium produced from Phase 1. This isn't just a handshake, it's one of America's largest automakers tethering its EV supply chain directly to this mine. So, if the asset is so good, the partner is world-class, and the government is a co-owner, why did the stock crash 40%? This brings us back to the expectation versus reality framework. The expectation is that building a secure domestic EV supply chain is a top national security priority. But the reality is that the global lithium market is a business, and right now, business is bad. The market is flooded with supply, primarily from China and Australia, at the exact same time that EV demand, while still growing, has hit some speed bumps. This oversupply has caused the price of lithium carbonate to fall off a cliff, down 90% from its 2022 peak. The market is worried that by the time Thacker Pass finally starts producing in 2028, the price of lithium will be so low that the project's economics won't be as stellar as projected. This is the core risk. It's not about the geology, it's about the commodity price spreadsheet. The entire investment thesis for LAC is a bet that by 2028, this short-term oversupply will have been absorbed by millions of new EVs and grid-scale storage, which leads to a new supply deficit. This is exactly what JPMorgan was referencing when they said the stock's value is tied to a tightening supply-demand balance in the latter part of the decade. This is not an Apple stock or Nvidia stock, which generate billions in profits today. This is a 2028 and beyond story. This is what makes online investment in a name like this so difficult. You can't just look at a PE ratio. There are no earnings. You are forced to become a long-term macro forecaster. This is where many investors look for investment help, either through services like Fidelity Wealth Management or robo-advisors like Schwab Intelligent Portfolios. Do you believe in the long-term electrification thesis? If you do, the US government has literally pointed to this company and said, this is the one we are backing to secure our supply chain. That's a powerful signal. But if you are a trader focused on the next 6 months, the chart is terrifying. The lithium price is weak, and the analyst consensus is a lukewarm hold. BMO Capital has a $5 target, Scotiabank is at $5, and now JPM is at $5. The message from the big banks is clear. The stock at its current price is fair. The wild rally was the expectation. The current $4.80 price is the reality. This makes the path forward for the stock a grind. It's no longer a rocket ship. It's a construction project. The catalysts are no longer hype and announcements.